Hello, guys, and welcome back to our series of lectures on international taxation under the New Income Tax Act and the New Income Tax Rules. In the first video, we have covered the first 10 fundamental concepts of international taxation. For example, we saw the concept of residence, scope of total income, double taxation relief, a basic non resident regime, foreign tax credit, transfer pricing provisions, APA provisions, safe harbor rules, etc. So in this second video, we are going deeper into the next 10 concepts, which will cover concept number 11 to 20. So let's start with the concept number 11 first. So this concept is talking about the role and structure of the tax treaties. All right. So section 159 and 160 of the Income Tax Act 2025, expressly provides that the government, may enter into an agreement with the foreign countries or specified territories for the avoidance of double taxation, also for the exchange of information, also for the, assistance in the collection of taxes. So these are our double taxation avoidance agreements, which we call as DTAAs. They kind of operate alongside the domestic law and which will be more beneficial to the SSC. So most DTAAs broadly follow the OECD model and the UN structure. They start with the scope and definitions. They include the concept of resident, concept of permanent establishment. They then kind of allocate the taxing rights, income headwise, immovable property, business profits, dividends, interest, royalties, FTS, capital gains, etc. And finally, they contain the administrative articles on non-discrimination clause, on mutual agreement procedure clause, on kind of exchange of information clause. If we see a small example here, if the act taxes royalty at a particular rate, but a notified DTAA prescribed a lower rate, na? So in that case, the taxpayer can invoke Section 159 read with the treaty to avail the lower rate, uh, which should be, subject to certain conditions. For example, furnishing of the TRC or the tax residency certificate, and also the, satisfying beneficial ownership requirements, etc. So this is the concept of tax treaties in a summarized manner. So let's proceed to our next concept, which is concept number 12, which talks about the treaty override and the beneficial provisions. So, guys, although the Act does not use the phrase treaty override, the scheme of Section 159 and 160 and the long standing practice in India, recognize that where a DTAA exists, a taxpayer is entitled to choose between the Act and the treaty and apply the provision which is more beneficial to the taxpayer. You know, so Section 159 contemplates that agreements may provide for relief from double taxation by way of exemption or by way of tax credit or reduced tax rates or any other appropriate provisions. So therefore, in a treaty situation, you do not look at the act in isolation. You have to read the act and the relevant TTAA together and then apply the provisions which is more beneficial to the SSC, subject to, of course, anti-abuse clause. So this beneficial treatment is not unconditional. Many DTAAs contain various anti-avoidance features, such as limitation of benefits articles and the principal purpose test, and kind of domestic act itself contain GAR and specific anti-abuse provisions that may deny treaty benefits where the primary purpose of an arrangement is to obtain a tax benefit only. If we see a simple illustration here, a non-resident shareholder is entitled to a 5% dividend withholding tax under the DTAA, while the domestic tax rate is higher. So if the shareholder can demonstrate that it is a resident of a treaty partner and meets the treaty conditions, and no anti-abuse provision is triggered, in that case, the lower 5% withholding tax rate can be applied at the time of withholding, and which would be treated as the rate applicable at the time of final assessment as well. So this is the concept of treaty overrides and beneficial provisions. If we proceed to our next concept, which is the concept of permanent establishment and business connection. So, guys, treaties generally provide that the business profits of a non-resident shall be taxable in the source state only if the enterprise carries on business in that state through a permanent establishment situated there. However, in the domestic law uses the expression business connection in section 9 to determine whether income of non-resident is deemed to accrue or rise in India or not. So, section 9 defines business connection broadly and through its explanations as well, and it includes the dependent agent situations where a person is in India, habitually concludes the contracts in India, a person maintains stocks of goods in India, or secures orders mainly for the non-residents or its group. And secondly, business connection includes the significant economic presence, which kind of addresses digital and the highly dematerialized business models, where there may be a very little or no physical presence in India. So, in a treaty situation, you first test whether there is a PE under the treaty's PE article. For example, a fixed place PE, construction PE, or service PE, or agency PE, basically. So, if a PE is found and the domestic law also regards the non-resident as having a business connection, only the profits attributable to that particular PE or Indian operations are taxable here. If we see a small example here, here a foreign company appoints an Indian subsidiary that habitually concludes sales contracts in India in the name of foreign company and maintains stocks to serve Indian customers. Domestically, this is clearly a business connection under Section 9. Under a typical treaty, these facts would also constitute a dependent agent PE, giving India the right to tax profits attributable to Indian side functions or Indian side assets and Indian side's risk. So this is the concept of PE in a summarized manner. So guys, let's move to our next concept, which is the concept of attribution of profits to PE or the business connection. So once a PE or a business connection is established, the next question is how much of the global profit can India tax? So the principle, both under the treaties and the domestic law, the principle is that only so much of the business profits can be taxed here, which is attributable to the operations carried out in India. In treaty language, the PE is treated as if it were a distinct and a separate enterprise, dealing wholly with the rest of the enterprise, and profits are determined on that particular assumption. So, under that new regime, this profit attribution exercise is supported by two concepts. The first one is the safe harbor rules, and the second one is the transfer pricing principles. If we take a small example here, you would analyze that functions are, so basically this example is containing a foreign bank with an Indian branch. So here you would analyze what functions are performed in India, what assets are used here, what risks are assumed here, say local loan origination and the customer relationship management, and then attribute an appropriate share of global banking profits. to the Indian branch, and guided by the safe harbor, range wherever available, and the kind of OECD aligned attribution principles should also be considered. So this is the concept of attribution of profits to the. Let's move to our next concept, which is the limitation of benefits and the treaty anti-abuse clauses. So, guys, most of India's modern DTAAs now contain limitation of benefits provisions or LOB clauses, which are specifically designed to counter treaty shopping. So, treaty shopping is a very important concept, and treaty shopping refers to a situation, where residents of third state route investments or payments through an intermediary jurisdiction solely, to take advantage of a favorable DTAA without having any real commercial or economic substance in that particular jurisdiction. So this is basically a definition of treaty shopping, which is a very, very important concept nowadays, if we see, practically. So while the Income Tax Act itself does not spell out, model LOP clauses, Section 159 allows India to conclude treaties that contain conditions under which treaty benefits may be denied, especially where arrangements have the main purpose of obtaining a tax advantage or tax benefits. So common, if we see the common LOB test, so this test includes number one, ownership and base erosion test, requiring that a certain percentage of ultimate owners are residents of the treaty partner, and that a minimum portion of the income is not eroded by payments to that third country residents. And the next LOB test is the business purpose test, which requires that entity has genuine business activities in the treaty country, and the next concept of LOB test is the listing or expenditure criteria, such as being listed in a recognized stock exchange or incurring specified operating expenditure in the treaty country. So if we see the example here, an intermediary holding company is set up in a treaty jurisdiction solely to hold shares of an Indian company with almost no local employees, no office, no operations there. So if the relevant DTAA has an LOB article requiring substantive business operations, listing or expenditure threshold, so this shell holding company may fail the LOB test and may be denied treaty benefits on dividends, on capital gains. So the domestic law rates will be applicable accordingly. So guys, this is the concept of limitation of benefits and the treaty anti-abuse clause. Let's proceed to our next concept, which is the general anti-avoidance rules, GAR, and its relation with the international tax. So, alongside the specific anti-abuse provisions and LOB clauses, which we have seen above, India has also enacted a GAR, General Anti-Avoidance Rule, in Chapter 11 of the New Income Tax Act 2025, which are covered in Section 178 to 184. So broadly, where the main purpose of an arrangement is to obtain a tax benefit, and it satisfies tests, such as creating non-arm's length rights and obligations, resulting in kind of misuse of provisions, maybe lacking commercial substance, or being carried out in a manner not ordinarily employed for, bona fide purposes. So it can be declared by the government as, impermissible avoidance arrangement. So the consequences of GAR can include, number one, it can include the disregarding the arrangement outrightly. It can also include the, treating equity as debt or debt as equity. It can also include the reallocating income deductions or the tax credit among parties. It can also deny treaty benefits that would otherwise, available under the TTAA. So the Act also prescribes an approving panel mechanism and certain procedural safeguards. So the GAR is not applied automatically. So if we see as example here, if Indian resident investors, round trip funds through a local or a low tax treaty jurisdiction using shell entities, with no commercial substance, other than just to claim the treaty-based exemption or the benefits of the reduced rates. GAR can be invoked in that case to look through the entire structure of the arrangement, and it can also deny the treaty benefits and the tax and tax transactions based on its real substance. So these are the implications of GAR. GAR is also very very important procedure or provision in our practical situations. Okay, so let's proceed to our next concept, which is the concept of notified jurisdictional areas. So, guys, another important risk management tool in international tax is the concept of notified jurisdictional areas. So, Section 176 here of the Income Tax Act, it empowers the government, to notify certain countries as notified jurisdictional areas, where, for example, there is a lack of effective exchange of informations or other specified concerns between the governments are there. So once it is notified by the government as a notified jurisdictional area, in that case, a special or a more stringent provisions can apply to transactions with persons located in those jurisdictions or those countries. So these measures may include, it may include the higher withholding tax rates on payment, such as interest, royalty, FTS, to the residents of such jurisdictions, and it may also include that the denial of deduction outrightly for specified payments unless additional conditions are met. The it can also include the stricter reporting and the documentation requirements in those cases. So the rules complement Section 176 by prescribing the forms of reporting, manner of reporting, and additional conditions in respect of transactions with such notified jurisdictions. If we see the small example here, suppose a low tax jurisdiction is notified because it does not have adequately, exchange information mechanism with India. So, payment of interest or royalty from India to entities resident there may attract higher TDS rates, and the Indian payer may be, denied deduction of such payments unless it can satisfy the rigorous conditions, laid down in the Act and the rules, thereby, discouraging basically the use of the non-cooperative jurisdiction. So this is the concept of notified jurisdictional area. Let's proceed to our next concept, which is concept number 18, and it talks about the mutual agreement procedure map. So map is basically a key and important dispute resolution mechanism built into most of India's DTAAs. So guys, where a taxpayer considers that actions of one or both the contracting states result in taxation not in accordance with the treaty. For example, due to transfer pricing adjustments, due to dual residence or disputed existence of a P, the taxpayer can approach the competent authority of their state of residence to invoke MAP. So on the domestic side, the Act and the rules provide the administrative framework to implement MAP outcomes. So we have Section 121 and the related rules specify the forms, the timelines, and the process for applying for MAP relief and for giving effect to decisions or agreements reached between the competent authorities. So in some situations, where we have safe harbor rules which has been opted for. The access to map can be restricted, which is also recognized in the rules as well. If we see a small example here, an Indian subsidiary suffers a transfer pricing adjustment in India, which leads to double taxation because the corresponding income is already taxed in the parent's jurisdiction. So in that case, the group may seek MAP under the relevant DTAA. The Indian and the foreign competent authorities can then sit and can consult and agree either on a corresponding adjustment in the other state or some other means to basically relieve double taxation in accordance with the treaties. So this is the concept of MAP, mutual agreement procedure. Let's proceed to our next concept of today. So this is basically the concept of country by country reporting and the master file. So, guys, following the global base erosion and profit shifting project, which we call it as BEPS. So, India has implemented country by country reporting and master file requirements for large multinational enterprise groups. So, Section 511 in Chapter 16 here, along with the rules 123 and 124 of the Income Tax Rules 2026. So, these provisions lays down the when the international group and the constituent entities must furnish the CBC report and the related information. So if we see key points here, Rule 123 specifies the detailed information and the documents to be kept and maintained by the constituent entities in India. For example, the list of the entities in the group, financing arrangements, description of the global value chains, etc. We have Rule 124 here, which designates the joint director as the income tax authority for receiving CBC reports, prescribes forms, 58, 59, 60, and, it also sets the kind of consolidated group revenue threshold, which is expressed in rupees, by reference to the TT buy grade, above which the CBC reporting is required. And we have Section 1511 here, which prescribed timelines for filing the report and conditions relating to systematic failure in exchange of CBC reports from other jurisdictions. So we have a small example here, a multinational group with a consolidated revenue above the threshold in rupees and an Indian parent or a designated alternate reporting entity in India. So it must furnish a CBC report in the specified form, showing, for each jurisdiction, the revenue, how much is the revenue, how much is the profit, tax, and the indicators, such as the number of employees, tangible assets, and nature of activities, etc. So this is the concept of CBC and master file, and it is also one of the most important concepts in practical usage as well. So let's proceed to our next concept, number 20 of today, which talks about the compliance ecosystem, international taxation. So guys, so this is our last concept before we wrap up this video. It is worth recognizing basically that international taxation is also a dense compliance ecosystem under the new income tax act and the new income tax rules. So from a practitioner perspective, the moving parts include, withholding tax obligations on cross-border payments of interest, royalty, FTS, dividends, and other income with higher rates in certain non-compliant situations. As a practitioner, we should also see the forms and statements for double taxation relief and foreign tax credit. We should also see the transfer pricing documentation, the master file, the CBC reports, the compliance of advanced pricing agreements, APAs, and safe harbor rules. The crux is that the non-compliance is not merely a procedural issue. It can result in interest, penalties, Not only interest and penalties, it can also result in the disallowance of expenditure. It can also include the denial of treaty benefits or the denial of foreign tax credit where supporting documentation is inadequate. So a small example here. Think of an Indian company making multiple outbound payments, for example, royalty, management fees, interest to different group entities abroad. So for each and every payment, it must evaluate the chargeability under Section 9. It has to check if the DTAA applies and whether a lower rate is applicable or not. It should also see, the deduction of tax at a correct rate and file the TDS statements in the prescribed forms. It has to maintain the transfer pricing documentation and treaty documentation, you know, and also support any foreign tax credit claimed by overseas group entities. So all of this must be, synchronized with the due dates under Section 263 of the Act and the relevant rules. So guys, this is our second video covering the 10 advanced concepts of international taxation. Let us quickly recap what we have covered in today's video. We have seen the concept of treaty override, treaty structure, permanent establishment, business connection, limitation of benefit clause, GAR provisions, notified jurisdictional areas, map provisions, country by country reporting, and the broader compliance ecosystem, in the Income Tax Act 2025 and Rules 2026. So thank you so much, guys, for watching this video, and stay tuned for the next video, covering the next 10 concepts of international taxation, which I will kind of record and upload very soon. If you are really finding this series helpful, please like, share, and subscribe my channel, and join me in the next video very soon. Thank you, everyone.